So welcome everybody. We're going to be covering a hot topic, cyber insurance, and what it means to you and kind of what it means to the industry. And I'm really excited about this session. And for those of you who've been tracking at home, I've only said that about the sessions that I'm in. So if you notice that, you're absolutely right. So we've got a number of slides we're going to talk through. We've got some great partners here on stage who have flown in from around the world in some cases to join us to talk about this very topic. So without further ado, I'm going to ask Sydney to introduce herself and then we'll go down the line.
Hi everyone, I'm Sydney Parassi with McGillen Partners. Really happy to be here and talk insurance. I've heard it's kind of a hot topic throughout the conference, so excited to be here.
And then Ryan Griffin, also with McGillen Partners. Been in this industry for 15 years, so I'm somewhat of a dinosaur despite my age. But again, looking forward to having a good discussion up here.
Hi everyone, Robert Booker again from High Trust, and I'm actually sitting in the seat of the CISO here, having served as a CISO of a Fortune 50 company for the last 15 years or so prior to my retirement last year from that position. So kind of talking about this topic from the perspective of having kind of lived it inside of an organization seeking underwriting and working with the underwriting community.
Yeah, so we're going to kind of give some context right up front. We're going to talk about the cyber insurance industry as it stands today. We're going to try to demystify some things for you all out there. We'll talk about the cyber insurance attestation process, the underwriting process, and then I'm going to grill these fine folks towards the end, and then we'll save. So if we can jump right in, Ryan, one, can you kind of just quickly touch base on what McGill is doing and where you stand in the industry?
Yeah, so just for clarification, don't shoot the messenger here. We're on the brokerage side. We are not an insurance company. So I don't think there's any cyber insurers in the room, so we're going to speak very candidly. We thought we'd just give kind of a quick history of where we are. I think we titled this slide Market Evolution. I could argue that we've taken 2 steps forward and 1 step back, so apologies for the last 3 years and the snapback that's happened. But again, the way we like to discuss this, for the practitioners in the room, the reason this insurance exists is for those in healthcare, right? When we think about the notification stuff that came out in 2003 in California and then the adoption of high tech, breach notification is really what launched this as an actual product. And then we all lived through the breaches in 13, 14, and 15, healthcare especially in 15, which actually made this policy relevant. And then the last 3 years have really been dominated by ransomware. I'd just like to remind everybody, in the world of insurance, cyber is a Gen Z baby, right? We think about introduced in the late 1990s. I mean, Lloyd's has been around since 1688. Sydney and I work with marine and cargo people. They have 350 years of data. We have 20 and maybe 2 years of relevant data. So I think what we have here on the slide today is just sort of the growth of cyber, but we always want to give the context of where we are. And so despite what you saw in 2020 and 2021 when rates doubled or tripled, insurers were crying that they were incredibly unprofitable. But what's happened in the last kind of 18 months is insurers have become wildly profitable in this space. You look at some of the leading insurers like Beasley, publicly traded, they're making about 24 cents on every dollar underwritten. So we're going to kind of try to fundamentally challenge how they're underwriting and look at ways to improve that process. But we just want to remind everybody that we're still early days for cyber insurance. I think this slide shows we're at about 12 billion in gross written premium. That yellow chart, just for those insurance nerds out there, 50% or more of all insurance that you all might pay is actually being ceded to reinsurers. So there's a lot of questions out there around aggregation of risk. Eventually, half the premium is going to a handful of insurers in the space. So that's a fundamental challenge that we're going to have to figure out. But you see the growth curve is there. S&P estimates that there's going to be about 30% growth annually. So hopefully we get to that $25 billion mark. But again, context is everything. P&C market is 1.9 trillion globally. So again, this is drop in the bucket. State Farm writes 70 billion alone in P&C insurance. So we're still early days. And I think our big takeaway is we are seeking external capital to come into this space. This is arguably an uncorrelated risk. Investors like those uncorrelated risks to balance out their portfolios. And so I think you're starting to see, and you will continue to see, third-party independent capital coming in that doesn't have an insurer logo on it.
Yeah, so Sydney and Ryan, we talked about in the agenda demystifying cyber insurance because some people in the room may have gone through the underwriting process, the application process, but it's still somewhat of a black box, I think, to some folks. So at a high level, how does the underwriting organization go about risk selection? And if you can explain what risk selection is, I think that would be helpful too.
Yep, so the first slide here that we have, we're going to toggle between risk selection and risk weighting. So the underwriters, we kind of took this from a snapshot of one of their playbooks. And we work with lots of different underwriters. They all say that they have a different playbook, but for the most part, their methodology is pretty in sync with others. They look at industry, they look at revenues, and they look at record count. So really the best way to underwrite, they kind of take their approach, but ultimately the methodology is pretty similar throughout the market.
Yeah, and if you look at, this is sort of a rudimentary look at like the CIA triad that a lot of you guys are probably familiar with, looking at confidentiality of data, integrity of data, and availability of data. But they try to heat map to see what the high impact and low impact looks like.
Yep, and then like I said on the weighting front, so revenues and industry sector are really kind of the two driving factors. A lot of the markets, based on kind of their reinsurance relationships, they kind of pick and choose what industries to really play in. And ultimately what it comes down to is risk selection and how they actually pull in different industries into their risk pool. No one wants to write all of the same industry or all of the same revenue class. They really want to kind of balance their portfolio to become the most profitable that they can be. But we have a couple other elements on the screen right now. Record count obviously being a big one in the healthcare and health tech space. Claims history being something that would influence your renewal outcome and whatnot. So taking kind of those two items, but also weighing the fact that we're in such a young industry that no one has kind of the perfect sauce, and they all kind of are evolving their strategy year over year to be profitable.
And remember, underwriters are looking at pools of risk. So yes, they want to pick the most mature risks to underwrite. But if you look at that bottom right-hand type of risk that is on that page, IT versus OT, I would tell you 3 years ago, nobody knew what OT was in our industry. They were desperate to get manufacturing and supply chain logistics firms into this pool of risk. And you could argue that bringing those into that pool of risk somewhat blew up a book, right? You had enormous disruptions and targets of ransomware for those in the manufacturing industry that was historically looked at as low risk. So again, we kind of deem the underwriting community as reactive as opposed to proactive, but we're getting there slowly but surely.
I think in the context of demystifying and kind of black box underwriting, most of the policies that we're looking at contain kind of the first party and third party insuring agreements. First party being kind of the most talked about, which would be ransomware, incident response expenses, reputational damage in the event that you experience a breach or a ransomware event. Third party, which really kind of ties into a lot of the themes that we've been hearing throughout the conference, is more kind of vendor risk. And when you think about all of these kind of technology firms, cloud providers, everyone is relying on different partners to give them different services, and there has to be a way to kind of coerce all of that risk into everyone has to carry a policy, your vendor has to carry a policy. So the reimbursement factor of in the event you are kind of sued or need to defend yourself if something goes wrong with a vendor that wasn't protecting your data. So that third party liability is often the black box piece. So we wanted to summarize that.
Yeah, and I think that's a big misconception in this arena. We call it a cyber insurance market, but it effectively contains all software services risk in that same pool of risk. So when you think about incidents that happen with vendors like Kaseya and others in sort of the critical infrastructure side, that is an existential risk for this book of business. And for those that are in the health system world, more and more you're becoming service providers to others through transition services agreements and reselling EMR implementation and that sort of thing. So again, these risks are colliding at a faster pace than ever, and the insurers are trying to underwrite everything to the best of their abilities.
Real quick before we get to the next slide. So you touched on the reactive nature of the industry at this point. I assume that's based on threats and how they're evolving.
No, Ryan, that's a great point. I think for those of you who've talked with your underwriters in the last couple of years, they are trying to adapt to be more of a threat intelligence source, right? And if you look at where funding is going in the VC world, a lot of them are backing insurtechs that are writing cyber insurance. So you're seeing folks coming out of the NSA, and from really turning threat intelligence firms and adding an insurance component on it. I think we ultimately have to decide, is that the best value proposition for this insurance? For small and medium enterprises, definitely, right? Where you do not have this level of engagement and maturity on a program. But it's a little bit, I'm sure all of you in this room have gotten alerts on outside looking in tools that say, this IP address might be associated with your infrastructure. Please respond to this, otherwise you're going to get an exclusion on your policy. I don't think that's a good look for the insurance industry. They should be looking at you guys and your SIM tools, your patching cadence, and what you guys are doing. You have a lot of those intelligence feeds. So I think we have to push back based on maturity of organization.
So what are the prerequisites that folks should be considering when going out to market?
Yep, I'll start on this and then pass it to the expert, CISO over there, Robert. But you guys are probably more than familiar with the items on the screen here. We would kind of classify these as almost the non-negotiables or the critical items needed to obtain a quality insurance policy. To give it context, the process, the insurance process today, the application process today, is more of a kind of check the box that you have these or that you're proceeding on a roadmap to achieve these. They kind of fall into the high trust 19 domains, but for the most part, they're very kind of high level. And I think with high trust and obtaining that certification, the compliance and the rigor around these individual domains is much, much deeper.
Yeah, and I know we've looked at this quite a bit. So those of you that are highly steeped in the framework will recognize that we don't yet have control specifications for every element of this. And I think that really gets to the reactive nature of how the insurance community operates today. And that's a challenge for us to lean in on as this partnership with McGill and others to really look at. Because if I actually go back and I reflect on underwriting discussions I had in, I think the last one I had was probably 22, and then 20, and then 18 or 19. These lists were very different. So the things underwriters were asking, and of course we were carrying a very large book of coverage. They were asking us very different questions year over year, and I find it really surprising and maybe a touch off-putting that you come in and you go to renew your policy, and suddenly it's like, well, now we need you to go put in XDR, which is, I think we would argue that there's still a question about what the true definition of XDR is. So I think from a high trust control perspective, this is always going to be a bit of us working through our threat adaptive model to keep the framework up to date. But I also would offer that if you can demonstrate a level of assurance, in the majority of these components with evidence, as opposed to just claiming, listen, I do it and I self-attest that I do it, where you're in a better managed situation. And for me, and I would just offer this is about creating a conversation with the underwriter or their analyst that's working on the policy application to actually say, let's talk about the fact that we have the framework, but we also have evidence that the controls are operating with effectiveness. And then there'll clearly be some additional things each year you're going to have to look at as threats evolve. But we're also looking at evolving our framework in response to that. So.
Yeah, and remember too that the underwriters, as part of this insurance package, they are reimbursing for incident response costs, most notably forensic investigations. And again, those investigations are always done under privilege, but the insurers are always seeking the least redacted version of that forensics report to uncover what truly was the root cause. And so if you look at some of these items, to Robert's point, they don't appear in 2019 or 2020, and then that particular insurer gets hit with 3 events that, like remote access MFA would have been a good mitigant to stop that. And so they're always going to be reactive, but it's troubling to us that, they look at the most recent incident they had and then immediately over-index to one particular area. And we know that things like PAM tools cannot be rapidly deployed in all environments, right? These things cannot simply be done overnight. And so holding you to account for this overnight is an unfair expectation. So I think that's one of the battles we'll have to continually fight with the insurance companies.
Hey, Robert, I'd like to come to you for a second.
Okay.
As a former CISO, I want to touch on it. And now too. Oh, here we go. Maybe this is the problem. I was holding it wrong. So I want to come to you as a former CISO. You touched on it really quickly. What was your experience? How did you find the process itself? And what do you think could be made better for today's CISOs and risk professionals?
Yeah, I'll qualify this. It's really more of a generic answer because I can't speak specifically about my former company, but my company and others, I think. So, I think in general it is a collaborative process, or at least it was for us. And I know that will vary by company size and by risk pool. But there was open conversations. We were discussing the risk. We were, and I think probably the last 2 years it got to be more prescriptive, which I think is responsive to what Ryan was just saying about the fact that the industry with losses has suddenly emphasized, more of a prescriptive approach to this. So I think, I think the frank fact of the matter is if you're actually working across a pool of different insurance companies, even though you may have a broker that tries to normalize that data, they've all got different considerations around risk. So what one broker might say is important varies a bit from what another underwriter would say is important. And so there is really this sort of dynamic environment that I'm not exactly sure until I begin the application process what it is I need to have. And my position would be if you're applying for a policy and you're told you need a control that you didn't know you needed and you have to go implement it, how do you possibly achieve a highly rated risk for that underwriter? So you're probably going to be considered to be a higher risk customer. So there's just not a lot of transparency to say it very directly and kind of bluntly, and I think we have to work on that. As a CISO and as a practitioner, I really felt like there was entirely too much reliance on me claiming that I was good without a lot of discussion about how do I know I'm good. So there were, conversations around we have assurance systems, HITRUST being one that we relied heavily upon, and there really wasn't an interest in those assurance systems today. I think it was much more of a, well, we understand you have that, but just answer our questions, give us the response. They might ask for evidence in 1 or 2 cases, but in the most part, it was like, tell us what controls you have and that you meet the control framework. And as a CISO, that was not fully satisfying for me because I'm actually thinking about when a claim happens, is there going to be some consideration that maybe I was not fully transparent in my underwriting, and now I have to fight to actually have the claim covered. So while that never happened, I was always concerned about that. And then I think so. I really think the landscape is how do I demonstrate a mature outlook to the underwriter, depending upon who on my team was asking the questions. There was a lot of ambiguity at the security leader level, like, am I getting first party coverage or third party coverage? And as basic as that would be for Ryan and Sydney here, I would find that colleagues would be mixing coverage considerations in the conversation, like, well, we need to have forensic help if we have an event, and we might have an investigation by a regulator, so which are very different types of insurance coverage. So I think just understanding the space is super important. So which is one of the reasons we wanted to have this session then. And ultimately it comes down for me to how much insurance is right for my organization. How do I quantify my risk? How do I think about that? And lastly, I'm always thinking about, will I partner, and does my policy create an opportunity to partner with my insurance company or their contract providers? Like if I have an incident and I need to have an incident response company come in and assist and help me with forensic analysis, and somebody that's seen this happen before and knows what to do about it. But I want to make sure that's the company that fits me culturally. Like if I get somebody that isn't aligned with my interests, doesn't understand my corporate politics and my corporate culture, and is going to kind of say, well, you have to do this because you have to do this, that may not be the most palatable way to work through it. So things like tabletops and exercises really important to us.
As I stand here, not awkwardly at all, I can't help but draw some parallels to the rest of the conference in being collaborative, being transparent, and actually having conversations with stakeholders, right? So this is arguably, in some cases, a third-party risk quantification and management issue than anything else. So curious, really, to any one of you, how do you see the attestation process evolving in the future?
Yeah, I can start on that front. I mean, I think one of the themes we've heard, and again, I appreciate you guys inviting the insurance folks to a conference like this, but hearing the term inheritance, I think that's a it's a really great way to describe sort of the culture of what you all are building with this community. And I think that can be leveraged in the insurance context, right? You're collecting this data, you're inheriting certain controls and maturity from key service providers and cloud providers. We think that's the next iteration of this insurance, so that all this good work you're doing is then inherited by the insurance companies, again, only to the level that you approve, right? I think we can all agree that no one is going to let, unlike a property insurance renewal where they go and tour a property, right, to see if you have sprinklers in the building, that the exit signs are correct. I don't think we're ever going to get to the point where you allow insurance companies behind your firewall. Maybe I'm wrong, but I don't think we're going to get there. I think there's a middle ground here on this inheritance concept that will move this along. And again, the piece that Robert hit on nicely is the insurers today they say they're doing quantitative analysis, but to some extent they were looking Robert up and down and said, does this person have the support internally? Does he know what he's doing at the helm as a CISO? Does the organization take this seriously? And that's fine and good, right, to get into the risk pool, but how do you fully differentiate the quantitative side as well? So I think the component of attestation is a really kind of a game changer for insurance, that you can trust but then verify that the controls are actually in place, and then provide evidence should you want to make a case that this was actually in place at the time. God forbid, we always say that it's only the largest losses that get excluded, right? The insurers are not going to deny a small claim because reputationally it's a killer, but they will deny a very large claim where you checked a box that said you had EDR on 95% of your endpoints, and then lo and behold, it shows that a critical system did not have any sort of protection or visibility. So I think that's kind of the big piece long term. Sydney, anything to add?
Yeah, just avoiding any potential for coverage rescission. this product, this insurance product is supposed to pay out. That's the value that we as brokers bring to broke something that actually pays out. So the last thing, you know, any of us would want is that the application process to be not rigorous enough that there could be some coverage issues. But I think, yeah, that demonstrated adherence, that actual proving that something is in place is great. And you guys, the compliance piece is all in line with the insurance piece. The CISOs are already going through to do this high trust certification, and kind of our goal collectively would be to inherit some of that that's already being done and ultimately make the CISOs and the IT professionals' lives easier.
And then that stakeholder evolution piece, I mean, Robert, you hit on that. How do you know, in insurance, we're always talking about dollars and cents. We try, oftentimes it's rolling up through a treasury risk management function, occasionally a legal risk management function. But how do you boil these scenarios down to dollars and cents, return on investment, and then the way we always look at this and try to get stakeholders around the table to agree is to say, we think we've mitigated X% of our risk. Here's that tail risk of whether it's 1, 2, 5%. And that's how insurance programs should be designed, right? And getting those stakeholders. So in this room, we've got the privacy professionals, the compliance professionals, the information security professionals, and then finally, the dollars and cents finance folks, you know, coming to a landing around what the right amount of risk to take on and how much you could offload, I think is ultimately the $1 million question. And ideally, you're thinking about that not 30 days before your insurance policy renews. That should be a discussion well off cycle from any insurance renewal.
So can we talk about current state versus future state for a second? Yeah.
Yeah, I think we've hit on some of this stuff, but we have no verification today. We take folks like yours word for it that the information's accurate, and then we do the pleasurable activity of saying, here, go on a Zoom call or go fly to London or go to fly to New York and sit in front of 45 underwriters and get grilled for an hour and a half, right? I don't think anybody likes that process, right? Some are better at it than others, but you know, they tongue twist you. They tell you, they ask you questions in a very certain phrasing. They'll ask you for, you know, the specific applications that you have domain admin accounts, and like, again, you don't want to show up to a meeting and be answering those questions in front of 45 people. We talked about that outside looking in. Yes, there's great vendors out there who can do external scans, but that doesn't tell a full picture. And then mostly we think that the work that's being done today is redundant. And Cindy hit on the potential for coverage rescission. But Cindy, you want to talk a little bit about future state?
Yeah, so we have a lot of assessors in the room, I'm sure. So leaning on you all to kind of check that box for us on the compliance piece. You guys are really the ones in the environment looking and seeing screenshots and really evidencing that you do have this in place. And I think where we are now, it's great because the insurance companies do accept an application that just is signed and dated, and it's, you know, other than completing the 200 questionnaire, that signature attests that everything is true and accurate. But in the event we potentially enter a new life cycle of this insurance, cyber insurance, you know, the 20 years of data that we have, there could be new threats, there could be, you know, changes in that. So having a way to leverage something that's already being done and really tried and true and tested by assessors, I think is the way to leverage that. And then, of course, we want, like I said, we want this to be an efficient use of your time, letting the CISOs do what they do best, not necessarily completing applications. And of course, some of the brokers have come a long way with, you know, where we started, but at the end of the day, it's always kind of backwards looking. We kind of would lean on high trust to be very in the weeds and more proactively looking at the threats out there. So ultimately, I think there's a way to make this a better process, and we're excited to kind of be on the ride to help get it there.
All right, it's time for the speed round. Cue the music, turn up the heat. All right, so I'm going to toss it out there. We want to talk about war exclusions, the SEC cyber rules that have come out recently, cloud aggregation, and risk quantification. So I'm just going to toss it over to anyone who wants to pile on any one of these topics.
I think I've spent collectively like 700 hours talking about the war exclusion, but I'll try to put it in like a 5-second blurb. Insurance never covers war, never has, never will, right? It's a correlated risk that is not underwritable. But I would say today you're going to see probably a big change on January 1st. The reinsurance contracts come up, and in all likelihood, we'll see standardized war exclusions that again just put effectively a standard in place at which what qualifies as war. And for everybody that's a U.S. domiciled company, that threshold to prove that, again, it's on the insurer to prove that exclusion applies, it's going to require an event perpetrated by a nation state actor that significantly impairs our U.S. economy and government. So again, the level of the threshold is going to be pretty high. So again, we're going to have to live with it. It's inevitable. There might be some write-backs. You might be able to buy back in the event a massive attack happens directed towards our economy. But for now, we're going to have to live with a threshold and navigate the scenarios that apply and don't apply. So I wish I had a better answer, but it's not going away.
And I guess we can touch on just speeding right through the speed round, the SEC cybersecurity rules. And I think, Robert, this might be a good time for you to kind of chime in as a CISO as well. But I think as we saw those rules passed in a 3-2 vote, it'll be really, really interesting to kind of see the cybersecurity professionals really come up in their careers and actually be part of the boardroom discussions with having to file 8Ks that contain information around potential breaches where that was not a requirement previously. I think the board would be smart to really embed some cybersecurity professionals into really get them to the table and have them be part of the conversation. Robert?
Yeah, we actually had a really good session yesterday morning with Chris Hetner and Kevin Charest on this topic. I know many people here were a part of that. I think sort of putting it in the insurance context, my view on this is about transparency, that you have identified your material risk, that those have been communicated up to the board, and that you're working closely with your colleagues in your legal and corporate risk group around ensuring that those are articulated in your SEC filings. And then of course the second part of this, which is also part of that for publicly traded companies, is incident response now. And I think there's been a lot of variability about incident reporting obligations industry by industry. This sort of levels the playing field of the fact that you will have a disclosure obligation if you have an event. And I actually think it accelerates the demand for, having coverage that actually helps you with the forensic analysis and the documentation needed to put forth a defensible notification that you've actually done the work. So I think it probably actually helps drive the case for insurance coverage, and it's just a reminder that you need to be very transparent internally and externally around the risk.
Yeah, and I think relatedly, I'll hit risk quant real quick. I mean, doing these exercises and putting dollars and cents on real scenarios that impact crown jewel assets at your organizations, doing that ahead of time, I think helps with that 4-day reporting and understanding what might be material. And again, that defensibility, should you ever get called before the SEC and you basically say, I had no idea what the impact of a cyber event was going to be, that's probably not going to hold water anymore. So we do have some coverage issues on potentially SEC investigations. We're going to have to figure out between directors and officers and cyber policies. So talk to your insurance professionals about that, but those solutions will exist. And then last but not least, I personally look at cloud aggregation. Again, we talk about inheritance. We talk about getting better resiliency, availability, better security tools by using folks who are here on the cloud provider side. Somehow the insurers view this as just massive aggregation, right? And rightfully so. but we are going to have to find solutions around cloud aggregation, a single event that takes out, a sector of, you name the cloud provider is going to trigger hundreds, if not thousands, of insurance policies at once. So again, when we talk about third-party capital coming in, we think that's one of the main areas where this might help. And then just a reminder, the folks at Google Cloud and AWS are rolling out pretty innovative insurance solutions on their own too. So I think we'll be able to solve this, but we've just got some growing pains getting insurers comfortable with what cloud aggregation looks like today.
Yeah, and I think there's a practical consideration of the cloud risk dynamic in that certainly underwriters have been very interested in where you host your data externally, historically. And if you're using cloud service providers, I think the fact that you have documented with clarity inheritance and compliance expectations with your cloud service providers, you can actually document by control area what they deliver on your behalf. And I know all of our cloud partners in the room are working very diligently with us to continually assess their environments in that regard. That just again goes back to my earlier point of saying is that we're not just saying to the underwriter, trust us, but we have data we can show you about our partnership with cloud supplier 1, 2, 3 that says how we very specifically validate their systems. And that should be a reason for you to be very comfortable that we've managed the risk of at least our one cloud relationship, which is obviously different than the aggregate risk, but important nonetheless. So.
All right, so we're coming up on the Q&A session, but in an attempt to preempt the one that I think is definitely going to be asked, how will these folks' high trust certification help during the underwriting process and ultimately the attaining of cyber insurance?
Well, I'm going to start because I want to thank the assessors again, and Sydney, thank you for acknowledging them. And high trust ask each of you, the ladies and gentlemen that do this work, to work very hard with us on independence and objectivity. And we have the whole quality process. You all live in it in a way that I can only respect because you work it so hard. There's a reason for that, and it's precisely for this type of problem. It's specifically so you can represent the objectivity and the independence needed to, illustrate with confidence to an underwriter that you're not self-validating the environment, but you're validating because you have sampled and examined evidence that is relevant to the controls. So I think first and foremost, everything built on the high trust assurance system, aligning to those controls that Sydney described earlier that I talked about, is important. We have to do further work on control mapping, especially because the insurance company changes the control map every year. But again, that's another opportunity for threat adaptive and having a very adaptive framework underneath all of this. So I think having reliance reports that are reliable is really going to be key to this. So I think there's work for high trust in the insurance industry to do together, and we're leaning in on that. I think that's an opportunity. So.
Yeah, and at the very least, in the short term, remove some of the friction in the underwriting process, and then long term, our goals are easy. We want to get better, more committed capital to those that spend the time, money, and the internal and external hours to maintain a certification. We want that to translate to better pricing and easier coverage to obtain. And we believe that pulling together a risk pool of mature risks ultimately will win the day in this industry. We just have to fight hard to build that product. So we're excited about that.
And from a practical perspective, as we open up the Q&A, I think each of you that have completed an assurance process with us have collected evidence and worked with your assessor to document what you do and how you do it. Just picking that evidence up alone and looking at it with regard to evidence for controls, it's a place to go, a library of work that's already been completed. And so, the insurance underwriters may, as of yet, require the application still. We're continuing to work on that, but you can actually answer with confidence and show them, listen, we've done it and we do it well. So that's a practical, first step for anybody that has an assurance report.
All right, so any burning questions out there? We did suit up Ryan and Sydney to deflect any and all objects. So what questions do we have from the audience?
I've got one over here. Good morning. Hi.
Oh, okay. Oh, thank you. All right.
Good morning. So with regards to high trust, certainly it's something that we all want to step forward and try and demonstrate with muscle what our security posture looks like. For companies that are maybe facing customers who want higher thresholds or higher coverage than their insurers are kind of happy to give with ease, I hear chatter about self-insurance. And this is an interesting conversation, but it seems to be getting more momentum. And I'm just wondering how you would respond to people who are considering that, and how high trust could fit into that picture or change the dynamic of the conversation.
Yeah, no, I think that's a great question. I would say Sydney and I in the last 2 years have had more discussions about self-insurance than we had in the previous entirety of our career, right? It's been the topic du jour, especially relative to price. I think the combination of, all these things are negotiations, right? And it depends on who has more leverage. Ultimately, combining confidence around your cybersecurity and privacy maturity should be first and foremost. But when you start to read the contracts, and again, depending on which side you're on, and you see these massive carve-outs for breach of confidentiality and unlimited liability, and then trying to back it up with, 5, 10, 25. I mean, if you work with some major banks out there, you have to carry 50 no matter what. And so I think it's an exercise of, depending on if your organization has captive insurance in place and are self-funding for that, you can evidence in creative ways out of those vehicles. And then there's other ways to evidence insurance coverage that's not full risk transfer. Now there's a cost to that, and ultimately you're taking that on your balance sheet, but that's gaining momentum. We do hope, though, that this insurance market continues to swing back in the direction where they're happy to give you those excess limits and happy to do that at a reasonable cost so that you can spread that out across all of the contracts that you might have as a service provider.
Right. And ultimately, most of the companies that we've seen that are exploring the self-insurance piece are very mature. They're happy to take it on their balance sheet because they've done the work. They're high trust certified. They maintain probably an R2 or the equivalent. And so our conversation on the brokerage side is, why would insurance companies not offer the limits for a company like that? In the end, they want to have the best pool of insureds. So that's kind of where we come in with our, nature to be a broker and get you the best outcome. So I think there's definitely been conversations. We have had some clients go down that path, but ultimately, I think the insurers would prefer that you stay in the risk pool, especially if you're a quality risk.
Does this work? Okay, good. As a company that's starting off in our high trust journey, trying to find ROI everywhere I can, to justify it. So you have two companies, all things being equal. One attests, one does demonstrative adherence to controls through high trust. Is there a quantitative difference in premiums that I can actually take back to the board and say, hey, we're going to get some kind of discount through the premiums of the insurance just by having that high trust certification? And what percentage would you say that's roughly?
Yeah, the short answer is not yet, right? We don't have these baseline. If we look earlier at some of the ways the underwriters are pricing risk, it is still black box. There's not a formula of number of records or infrastructure or number of endpoints times X dollars today, but we do believe that there is a path forward to give that better capital, better pricing for those that have achieved it, and bring more value to this certification process. So I'd say not yet, but we don't think it's an impossible task.
Thank you. We're, excuse me, service provider, and I believe I'm hearing with High Trust, my potential client has a better opportunity of when they receive that long questionnaire that they're more prepared for it. Do you see, and this is just an observation of yours, they are telling me, they answer all the questions, all of a sudden it comes back and their price still goes up 30%. And so that's the frustration that they have. Is that what you're saying? It's going to take some time that we can get them involved with High Trust, that the industry will then be a little bit more favorable through you as far as agencies that will take that into consideration?
Correct. I think what we're looking to do is smooth out the volatility of this. I mean, if you look at what pricing has done in the last 3 years, from 2014 to 2019, on average, prices just decreased about 5% annually. And then starting in 19, they went up 70%, then 110%, and then 30%. And now they're coming back down on another 30% or another 40%. And so as much as you like to ride the downswings, nobody likes to ride that compounded upswing. And so again, bringing a mature risk pool into a marketplace and asking certain underwriters if they want that pool, that's the name of the game in this industry, and it just hasn't been done to date with a huge commitment. And so that's future state for us, and which will make all companies feel a bit better on ROI, transparency, predictability on budget. This was fine when this insurance cost $50,000. When it costs $2 million for $30 million of insurance, nobody can absorb those hits to the budget. So we know the pain. We got yelled at for 2 years as well. So we want to fix that.
So I have a question regarding emergent threats. So look specifically at like AI's capability of exploiting and exposing vulnerabilities that we expect to scale quite a bit over the next year or two. How do you take that into risk factors and specifically looking at premiums rising? Is there a good way of tracking like how these emergent areas of threat are going to affect premiums?
Yeah, the AI topic no doubt comes up in every underwriting shop out there. Frankly, today it hasn't been a huge area of focus on the cyber threat side. I think they're more worried about plagiarism and other claims. As I talked about earlier, we also have media in this book of business. So when we think about the use of name, image, likeness, and what that might look like for each and every company, that's frankly where they're probably spending the most time trying to understand how AI changes that. But I think we can all agree that the threat landscape, especially as it comes to social engineering, is only going to get harder to navigate. And I think it's going to become, we're going to see more and more requests, and back to an earlier session today around kind of the AI assessment going forward. We're going to have to be aggressive with underwriters to say how each organization is tackling that threat proactively and beat them to that, because once they see that first claim that came out of an AI-related threat, we're going to see a deluge of questions. So just trying to get on our front foot is about the best answer I can say today.
So unfortunately, I think that's all the time we have for questions. If you have additional questions, Ryan and Sydney will be here all day and I think into tomorrow. So find them, corner them, don't hurt them. But I want to thank the two of you for making the trek and coming up on stage and being so brave and transparent and candid. So thanks so much.